Time to see what's on the radar, and we are here with Rebecca Teltscher, the portfolio manager at Newhaven Asset Management. And Rebecca, let's get started. Up in the skies, sort of. I guess fake skies, CAE.
So it's interesting. Before the commercial break, we talked about the sectors that we like: utilities, telcos, and
Good
pipelines.
solids.
Yeah,
Good
the good solids. Now, I thought it would be interesting to talk about some stocks that are actually more cyclical. So I would say like the riskiest stocks that we have in our portfolio. But I'll tell you why I like them, because they all, even though let's just say they're in, the industrial space or construction, they have defensive-like characteristics that we still like. So even though they are often a little bit more volatile than our stable and true stocks that, like the utilities, they do have a lot of qualities that we are interested in. So you mentioned like CAE. Again, one of the few stocks, there's only two stocks that we own that don't have a dividend. This is one of them. And if you look at CAE's two lines of business, civil aircraft. So again, we don't like the airlines, like we wouldn't invest in an Air Canada because it's very cyclical. And again, we're talking about that strapped consumer who may stop, traveling. But we invest in CAE for the civil side because of the shortage of pilots.
Yeah,
and that's
they do training and simulators, right?
Exactly, training and simulators. They've signed recently a contract with WestJet. I think yesterday they announced a contract with Malaysian Airlines. So they do the training for all of those companies. And again, if you are hiring, I think it's like 260,000 new pilots over the next decade, you don't just start flying, a 737. You have to start, small. You do a bunch of hours and then you graduate to the next size aircraft. And then, so it's a real continuous, again, that long-term contract, continuous stream of income. Then the other side of their business is the defense. That's actually the side of CAE that had historically lagged because of some legacy defense contracts. But again, Carney, earlier this year announced a huge amount of spending on, the defense side that, again, should prop up, that sector, over the long term. So again, we're looking at, secular growth, long-term contracts, and government spending that's backing, this revenue. So for a long term, we think that's a great stock. Okay,
we want to get the other two in. Aecon construction, people think home construction, but it's a lot more than that.
Yeah, so over half of their business are, so utilities, nuclear, almost every nuclear project in Canada, whether it's a refurbishment, a new build, SMR, small modular reactors, are, Aecon is touching those projects one way or another. The stock was up 13% on Friday because they made an announcement of their first nuclear SMR deal in, I think, Washington State, so in the U.S. So that's a great entry to the U.S. We were kind of discussing, nuclear. At the end of the day, renewables are important for the future, but we also need that baseload energy that's either going to come from natural gas or nuclear. And Aecon really has a moat on that nuclear build. And if we can export some of those capabilities into the U.S., there's a lot of growth there. But also, a lot of their growth is coming from transit projects, like they just did the Eglinton LRT, the Finch line. Those types of things are, again, more defensive in nature. Even if we're in a recession, the government is going to have to spend. Public spending, they are a necessity. So again, that, even though it's been a more of a volatile stock, I think the backlog is biggest than it's ever been in its entire history, and I think there's real signs of secular growth there.
Okay, and then going to move on. Last one is the NFI Group.
Yep. So the second stock that we have that doesn't pay a dividend. Again, I promise we're dividend investors. These are just the only two.
You gotta have a little bit on the side there.
But again, they're bus manufacturing. If you think about in the pandemic, their ridership was really low. These transit companies spent very minimal on growing their or investing in their buses. So now those buses are very old. They're 5 to 7 years old. They need to be replaced. NFI, and there's been a lot of competitors since the pandemic who have gone bankrupt, who have left the space. So NFI has very minimal competitors in a space where they're able to increase prices because they're almost a monopoly in every jurisdiction that they operate in. And, these are public contracts that are needed despite where we are in the economic cycle. They need electric buses, so they're converting their traditional combustion engine to an electric bus. And, all of these aging fleets, they need to be replaced over time. So right now they're I think they're taking orders back into the second half or the end of 2026. Like, they cannot build buses fast enough. The problem with the stock has been more supply chain issues, not about their backlog. Their backlog is super strong. So I think once, those backlog issues come to an end, whether it's the seating or there was a battery recall, again, not necessarily, it's not their fault, but it has been causing delays with regards to their production line. But once they can get that sorted out, the future earning potential is really great. Again, long-term contracts and stability.
Okay. We're going to leave it on that note. Those three stocks again: CAE, Aecon, and the NFI Group.